Welcome to my YouTube channel, The Classic Mortgage Man. This YouTube channel was created in order to get a deeper understanding of the home loans and its processes. Since 2015, I've been a licensed loan officer here in Texas, and I've helped over 380 families become homeowners. And so my goal is to be able to explain and give a little bit more in-depth detail about the different types of loan programs and to dispel any myths that are out there, and be able to help people get approved faster and not be able to lose any money or time in the process. So today what we're going to talk about is how to get pre-approved, what documentation that's needed, and what information you need to give your lender in order for them to be able to answer your question and help you along your home buying process. So, number one, you must have a valid driver's license, passport, or ID. It cannot be expired. Number two, you need a legible and signed Social Security card. For any reason, if your Social Security card is not readable, the simple solution is go to the Social Security office and order a new Social Security card and provide the receipt to the lender. Number three, 2 months copies of your bank statements, and it must show the web URL at the bottom of the bank statement, or you have to go to the bank, get a copy of your bank statements and have the bank to stamp it. And then that will be an acceptable copy that you can give to the lender. Now, question, most people want to know, why do they need 2 months bank statements? What they're looking for is to see where your money is going into, and they also are looking for the management of your income. If you have insufficient funds, the lenders does take that into consideration when getting approved for a home loan. Number three, they're looking for undisclosed debt that's not being showed on your credit report, such as if you had a auto payment that's drafted from your account, but they don't necessarily report it on your credit report. So they look for those things like that, or even if you were paying the IRS, like if you owed the IRS money, it would show on the bank account. So you have to show copies of your bank statements. Number four, now you have to show what you call your qualifying income. What do you use for income? So if you're a W-2 employee, you want to show your last 2 years of W-2s, and then your most 2 recent pay stubs. If you're self-employed, they want your last 2 years tax returns, all pages. Even if you're doing a LLC, they want the business tax returns and your personal, because it is about what you reported to the IRS after your write-offs and deductions. You also can use other income, qualifying income, such as if your child is 14 years old or under, you can use child support that is ordered through the Attorney General's office. If you receive Social Security benefits, such as disability or just regular Social Security pension funds, you can use that as income. With the VA, Veterans Affairs, you can use non-GI money that's not used for school, that you get from the VA. You can use that as income. Use royalties, rental income that's reported to the IRS. So whatever you try to use for income, that's what you want to give that income to your lender. Now, one of the most important things that you have to be transparent on your loan application is your marital status. Why does this matter? So here in Texas, Texas is a community property state. And what that means is if you're legally married, your spouse has rights to the property when you're buying a primary residence. And depending on the loan program that you're interested in, such as an FHA loan, a USDA loan, or a VA loan, if you're legally married, you must put your spouse on the application, because you're going to be responsible for their debts, even if you don't want them on there. So having the correct marital status on there does matter. And then the last piece, which is the most important piece, you must complete the loan application in full. Once you complete the loan application in full and you provide all this documentation, your loan officer now can review your credit report and the scores, the debts. They can review your income, and now they can see what loan programs you possibly can qualify for. Now, here's the questions that are the information that you need to give your lender in order for them to be able to answer your questions. So number one, you want to let them know when you're wanting to buy. Now, why is this important? If you're wanting to buy 30 days from now, 90, 6 months, or a year, the reason why it's important is when you do a loan application and we pull your credit report is only good for 4 months. So that means is if you were trying to buy a new construction home that's going to be built 6 to 8 months from now, or you're not looking to buy until 6 months or more, you have to go into the interaction understanding that you may get pre-approved today, but they're going to have to re-pull your credit again if you're not purchasing until after 4 months. So that is very important that you give that information to your lender so you can know if you want them to pull your credit right now. Because you may just say, hold off. Don't, we're just not going to do anything because I'm not ready for 6 months. Because they really can't answer any questions without looking at your credit reports and your debts. Number two, you got to let them know where you want to buy. Well, reason why that's important is, see, depending on the zip code or the side of town you want to purchase in, or even the subdivision, the property taxes are going to be different. As an example, so you can see 2 homes in the Cypress area. One subdivision was built in 2005. The other one was built in 2007. Well, the one in 2005 is going to have a cheaper tax rate than the one in 2007. So both homes could be $250,000, and you're going to get 2 different payments because the property taxes are different. So giving this information to your loan officer gives him a better chance to give you a little bit more accurate loan estimate when it comes down to what you're looking for. Number 3, you have to let your lender know how much money you have for the transaction, and out of the amount of money that you have, how much of it are you willing to use toward the purchase of the home. Most people focus on just the down payment, but when you're buying a home, you have a down payment, you have closing costs, and then you have out-of-pocket expenses. So part of your down payment is the earnest money deposit that you have to have up front, but then also you have a home inspection, and then you also have an appraisal inspection, which tells you the value of your home. And then as far as closing costs are the lender fees, title fees, your property tax and homeowners insurance escrows. If there's a homeowners association, there's a setup and transfer fee. And all these things tie up into what is a combination of your closing cost fees. Closing cost fees can range from 3% on up depending on what's negotiated. So a lender wants to know, okay, if you tell them I have $30,000, that's great. How much out of the $30,000 are you willing to spend toward this transaction? So that way they can give you some guidance on to know what you're going to be looking toward if you decide to move forward. The next step is you got to let them know the sales price you're interested in, and then the last part you got to let them know is what's the maximum mortgage payment you don't want to go over. So all these things tie in together. So when you let them know, hey, I'm wanting the house my wife and I like is $350,000, and we only want to use $20,000 for the whole transaction. Okay, so if it's an FHA loan, it's 3.5% of the sales price plus your closing costs. That's going to be somewhere close to around $20,000. So now when you say, well, hey, I only want my mortgage payment to be $2,000. Now that's when they're going to do all the calculations, and they're going to look to see if you can give them an address of a home you're interested in. Now they can let you know, does it line up? Does everything line up according to how much money you want to put down and what you want your mortgage payment to be? Because your mortgage payment consists of principal and interest, property taxes, homeowners insurance and mortgage insurance. So it goes back to what we talked about earlier. Where do you want to live? Those property taxes, you gotta, the lender can tell you by going on har.com, hey, here's what the property taxes look like, here's what your principal and interest look like, so that your mortgage payment will look like X amount of dollars, to see does it fit within the spectrum of what you're wanting to spend. So when you give all this information to your lender, they can now give you the accurate information that you need. So now that you're empowered, so as you get ready to go on your home search to look for a home, you have the right information in front of you, and there's no more assumptions about what you think your payment should be or what the process should look like, because you now have all the information in front of you. So for tips like this and more videos, click the like button and subscribe, and you will see more videos in the next few days that talks about the process. It talks about some of the different loan programs that you could take advantage of and what you need to do in order for the underwriter to give you the yes.